Hello, and thank you for joining us today. I want to welcome you to the February GCLS virtual event, Taxes for U.S. Author. This event is sponsored by Karen Callmaker. Thanks again to Karen Callmaker for sponsoring this event. To make this session as interactive as possible, please use the Q&A box during the entire session. Feel free to start asking questions right away. You are also welcome to use the chat function, but remember to change the to option to everyone. Also, please respect the GCLS Code of Conduct, which you can read more about in the chat and on the GCLS website. Let's get started. We hope that you enjoy this event. I'd like to turn over the session now to Ann Etter.
Hi, everybody. I'm Ann Etter. Many of you know me from social media, and some of you may have heard my voice in some books, but my day job is as a CPA, and I do a lot of work with artists, authors, small business owners, sole proprietors. So what I'm going to be talking about today has a lot to do, mostly to do, with people who file a Form Schedule C, and that will usually be the small sole proprietors. Some people may have a slightly larger business or may have made certain elections to be treated as a slightly larger business or in a different sort of tax structure. And I can get into that a little bit near the end, but for what we're doing today, it's going to be a lot of basic things for a very basic Schedule C that you report on your personal income tax return. And I realize I just did a lot of accounting words there. My apologies. So income, let's start with what is income. And one of the things we've made available to everybody is this particular Word document. You have access to this via the chat, I believe. You can download it, you can make notes on it. It's got a lot of white space on it for people to write on it. And at the very bottom here is my email. If you have questions that we don't get to during this session, or you're lying there tonight and you're thinking, oh, I should have asked, you can feel free to email me at that email, and I will be able to answer questions over the next week or so. Which isn't to say you couldn't email me later. I just mean the turnaround time might be a little bit depending how many questions I get. So let's start with, what is income? Income is very specific to what you receive for your services or for your books. Whether you're editing, narrating, writing, whatever piece of this you're doing, income is what you receive for those services. So when you sell, your royalties are always income. If you write and then let's say you also edit and someone pays you to edit, that is also income. Things that are not income that people sometimes get really confused about, loans. So let's pretend that you're going to do some large, some business expansion, and you go to the bank and you get a loan. That is not income. You do not pay taxes on that. That's something that you're going to have to eventually pay back to the bank or to parents or whomever, wherever the loan came from. Gifts are not income. So sometimes you might have a friend or an aunt or an uncle or somebody out there who says, I love what you're doing, and I really want to give you a gift to support it, to help you do this better, to help your business. That is not income. You don't have to report it. You don't have to pay taxes on it. Now, if someone says, hey, would you please write me a book? And you agree, and they pay you $1,000 to write them a book, that is income. But for someone who says, I just love what you're doing, and I really want to support it, here's a gift. It's not income to your business. You don't pay tax on it. Money that you transfer in from your personal account. So I have seen sometimes, you should have a separate checking account for your business. And oftentimes people will just say, oh, well, XD amount went into that account this year. And so that's the income for my business. And they forget to look back and check, oh, did I have to transfer any money into that to meet a bill or for whatever reason? So you need to make sure that you're accounting for those things as well, because money that you transfer from your personal money into your business account is not income and you don't pay taxes on that. Does anybody right now have questions about income? Have we had anything come through the chat or Q&A asking about income, types of income?
Not at this time.
Okay, let's go on to the really exciting part. Oh, I see a question that just came through. Is an advance on royalties a loan? No. An advance on royalties is income. All royalties and however they come through are going to be income. So deductions, what is deductible? What are your expenses? What can you actually write off here? Travel is a favorite one because who doesn't want to travel and be able to write it off? But there are very specific ways around which you need to organize your travel in order to be able to write it off. If you're going to something like the GCLS conference, that's an obvious one. Absolutely 100%. You get to write off your airfare or your mileage on your car, however you get there, train fare. You get to write off your cost of the hotel. You get to write off the meals that you have there. You get to write off if you have to, let's say that you ship a box of books because you're planning on selling books there. You get to write off the cost of the shipping. So whatever it takes for you to be able to go to the conference. Now let's pretend that you decide, oh, the conference is what, 5 days, and then you're going to spend another 5 days scooting around because it's in a really cool place. It's in Albuquerque this year and there are a lot of fun things to do. So the time that you spend at the conference, the hotel, the entire plane fare is deductible. However, those extra 5 days that you're doing on the side just to have fun, to go around and see things, that is not deductible in terms of the hotel and the meals and whatever you decide to see. However, your plane fare is still 100% deductible because your main business purpose for going to the conference or your main purpose for going to the conference and for going to Albuquerque is business. Travel does have to be premeditated in order to be written off. So the example I usually use is where you and the family, you go to this wonderful castle in Ireland and it inspires you. And you spend the next 2 weeks completely ignoring your family. You're holed up in the castle's office, typing away on your typewriter, writing this wonderful, wonderful novel. And you get home, you can't write off that trip because that trip was at its heart a pleasure trip. You turned it into a business trip partway through because you got this fabulous idea, but it was at heart a pleasure trip. None of it can be written off, even if the novel earned you millions. In order to make a trip like that a deductible business expense, you would need to have thought, I'd really like to write a book set in Ireland. And so then you plan ahead, you pitch the book to your publisher, you have something that says, yes, I've thought about this, I've written out, this is what I want to do, and now I need to go research. And then you take a research trip to Ireland. You can bring your family with you. Their stuff is not deductible, but yours is, your hotel, your flight, your meals. You do your research. You need to make sure that the bulk of what you're doing is research or writing. And by the bulk of 51%, so more than half of your time should actually be spent on business. And then you can write it off. You get to write off your entire plane ticket. You get to write off all of your hotel. You don't get to write off the side trips you did for pleasure. So that's one of the really important things to remember when we're talking about taking travel as an expense. And travel can be a very significant expense when you are writing. If you want to go and figure out what is it really like in the place that you're writing about if you're not writing about your hometown. And then, of course, going to conferences and chatting, meeting up with other authors, meeting up with other people in the profession. Your phone. So if you use your phone a lot for conversing with people, conversing with your editor, we can take a business percentage of your phone use. Currently, the IRS does not require that you document that. So currently you can say reasonably, I spend 10% of my time on the phone with my editor, or maybe it's 50%, or maybe it's 80%, whatever it is. The one thing the IRS is never going to believe that you spend 100% of the time on your phone for business. That's not going to work. Internet. You use the internet a lot, maybe for research. You use the internet a lot for communications. Again, business percentage of internet. So the amount of the time that you use the internet for business versus what everybody else in the house, including you, use it for pleasure. So that might be, if you have a bunch of teenagers, that might be 5%. If it's just you, maybe it's 50 or 60%, depending on what you do the rest of the time via the internet. Supplies. I used to have a tax professor who said, well, when you've depreciated your pencil, but really in the end, whatever supplies you are using, not the M&Ms that you're eating, but the red pen you use to circle those the words on when you're doing proofing, your computer, your printer, your ink on the printer, any and all of those things. Karen, because I know you. Karen asks, M&Ms, how do I know? I know. Per diem. So if you are traveling for work, so we're back to the travel a little bit here, and let us pretend that you live in Minnesota, where I live, and you drive to Chicago for the weekend because you've set a book in Chicago and you just want to make sure you have everything right. And you're going to, let's pretend that we eat at McDonald's every day in Chicago because we just haven't had time or we're feeling inexpensive right now. But Chicago's per diem is something like $79 a day. The one time the IRS gives you maybe more write-off than you actually spend is in a per diem. So when you're traveling, you're traveling for business purposes, your meals can be written off as a per diem rather than keeping all of the receipts. So that means that if you go to Chicago and if you eat at McDonald's or wherever, or you bring your own, you pack your own lunch, dinner, lunch, whatever, you can still take the $79 or the whatever per diem. Per diems can be found online. It's a quick Google and you're looking for the per diem. It is done, I think it's put out, I want to say by the US State Department. But it is a government site and it will show per diems for hotels and per diems for meals and incidentals. And it's the meals and incidentals per diem that you're looking for. There are also international per diems. So if we go back to that one, that Irish one that I was talking about, you can write off a certain amount per day. Per diem means per day, essentially. So it basically just says that this is the amount that the government would expect you to spend on meals in any given location. And that saves you from having to maintain receipts from meals, which the IRS actually understands can be difficult. Consulting. So you hire somebody for whatever reason. I mean, you can hire people to proof, you can hire people to edit, you can hire people to give you advice about, let's pretend you're writing a Hollywood story set in Hollywood and you've never been and you don't really know what an actor's life is like, but you can hire someone to tell you about that. Oftentimes we find volunteers and it's all wonderful and it works out well, but other times, a lot of times the information or the whatever we need to pay somebody for that. That is deductible. And also, if you take your favorite editor out to lunch or whatever, that is also deductible. Other things that might be, those are the ones that I generally list. Other things that might be deductible, anything that is necessary for you to sell your work or for you to produce your work. Advertising, sponsorships. So Karen sponsored this, so that's a deduction for her actually. So it's super generous and wonderful, and it also works out as a deduction because she is getting some visibility for her books. With donations, we run into something a little bit different. So if you are donating, if you donate money, like say you love GCLS, you're super excited about the things that we can provide, you're excited about events like this, and you give a donation to GCLS, that donation goes on your regular itemized deductions. If you did this back in 2021, you got it right on the front of the tax return, it's a little special deal. Hopefully Congress will see fit to extend that. They haven't yet, but it is deductible as a donation. If you're doing something like a sponsorship where you say, yes, I would like to sponsor this particular event, that gives you a certain amount of advertising, essentially. You're getting some advertising for your books, for your product, for your work. Advertising is something that you actually get to deduct right off of your business expenses. If you donate your own work, this is the one bad news thing that I have, and the thing I hate saying on all of these. If you donate your own work, so you have author copies of books, and there was no out-of-pocket from you for those books, you don't actually get any deduction for donating something for which there was no out-of-pocket. If you donate your time for whatever purpose, you know, I donate my time today to talk about this, I'm donating my time to GCLS, there's no deduction for that. The IRS has yet to come up with any kind of way of valuing people's time for when they donate their time. If, however, let's say I went and I bought a copy of one of Karen's books, and then I won a copy of the same book, and well, I don't really need 2 copies of the same book. Maybe I do, but let's pretend I don't. And so the one that I had bought, I donate then to the GCLS auction. I can write off the cost of what I purchased that for. So if you or if you have to purchase one of your own books for whatever reason, you're out of author copies, and then you donate to something, you could write it off that way, but there has to be out of pocket. It has to be out of pocket. Any questions on deductions?
And I just want to make you aware that there are some questions in the Q&A in the bottom of your tray. I just want to make sure you saw those.
All right, let me open those up. Patreon income, yes. Patreon income is indeed income that does count. If your Patreon is related to your service, to your profession, to what you do. I know there are times when Patreon could be questionable and could be considered, but for most purposes, for what we're talking about here today, you have Patreon author account, it is income. Oh, Cindy, great question. The case that you can only deduct 50% of the cost of meals on a business trip. The IRS has all sorts of fun new rules around this that were put in place for COVID. So in general, if your meal was purchased in a restaurant, you can get the 100% deduction. But if it's takeout, it's the 50% deduction. But there are all sorts of fun things around that. So I will, in this case, I would look at each thing specifically and individually. And that is something, if you have a specific and individual question, go ahead and shoot me an email on that, and I'll answer for your specific thing. So Allison asked about a novel being set in New York and going there and researching it, and what happens if the book doesn't get published. So you can write off expenses required for a book that in the end doesn't get published for whatever reason. But there's one huge caveat, and that is don't ever take expenses if you have zero income in that year. That is raising your hand and saying, oh, please audit me. I really want to get audited. And no, you don't want to get audited. So if you, as long as you have income, it doesn't have to be income from that specific book. So, because oftentimes, you know, you're writing a book for 4 months before you publish it, sometimes a lot longer. And we know that that can go over the course of you know, between calendar years or whatever. The other thing too that I will add here is that out of every 5 years, you need to show some actual income in three of every 5 years. If you do not, the IRS may decide, oh, this is a hobby, it's not really a business, you're not really trying to make money on it, you're just having fun. And when they do that, then they disallow all expenses and it's not fun at all, and we don't want you to get audited. So in general, make sure that you're not claiming losses too many years in a row. You are required to report 100% of the income you receive. You are not required to report 100% of your expenses. The only time that you might be required to report 100% of your expenses is if you fall into the category of someone who qualifies for the earned income credit. If that is a situation you find yourself in, it is very, very much worth hiring a competent CPA to walk you through that so that you don't end up in trouble with any of that. Yes, there's a question. Do you have to report your expenses in the same year you incurred them? Overall, mostly, usually, yes. There are times and places where you may be able to or want to report on an accrual basis, but now I've used a big accounting term. We don't recommend that. We recommend cash. And there are times also if you're just starting up where you may want to include certain expenses as startup expenses. And so maybe you started your business in the fall, you didn't really get going until the winter. And so you may be able to include some startup expenses in the following year's tax return. If you don't have a publisher yet, but you go to the Library of Congress for research, can you deduct it? Yes, again, with the caveat, don't deduct if you don't have any income. Professional association fees, 100%, write that off. All right, I think, let's see, oh, more indie authors paying out of pocket for author copies. Yes, you can deduct your actual cost. So that means if it costs you $5 to get the book and you're selling it for 10, you get to deduct 5. Not the 10 that you're not the amount that you are foregoing, but the actual out of pocket. Health insurance if paid by the business owner, absolutely. Health insurance is kind of a fun deal. It actually comes off in a different part. You won't report it on your Schedule C. You'll report it on a different part of your tax return. And you need to not qualify for health insurance under your spouse's employer account. So there are a few health insurance caveats as well for taking the self-employed health insurance deduction, but that is one that is very important and can be worth a lot of money. Again, that's one where I would check in with a CPA on how to do that. Software with a monthly subscription, absolutely, 100%. Yes, so here's a great question. If you write mysteries, can you deduct the cost of the books you purchase in the genre to keep up with the genre? Absolutely, absolutely. You can also, if you are thinking about, let's say you've been a romance novelist all along and you're thinking about writing mysteries, you could also reasonably, if you plan actually to write a mystery, start deducting the cost of mysteries that you're reading in that genre as a learning as a learning opportunity, even before you've published a mystery. Income or profit 3 out of 5 years. Yes, please. That just saves you from the pain of an audit. Well, can help save you from the pain of an audit. Oh boy, so first book being published in 2022, but most expenses were in 2021. Email me and we can talk about what you can deduct. Do you need to save up or account for withholding? Oh, this is always super fun. So estimated tax payments basically is what we're talking about here. So when you work for somebody else, you have withholding, right? Your boss takes your company takes a certain amount that they pay into the IRS on your behalf for your anticipated income taxes. When you are self-employed, you will likely, hopefully, have income and you will have to pay tax on that income, and nobody is collecting it and sending it in for you. So every quarter, and by quarter in the IRS, they actually mean April, June, September, and the following January. So they don't even really mean quarters, but we call them quarterly. You pay in a portion of how much you have made net. Net means the income less the expenses. So if someone asks, what is your net income? That means they're saying, how much did you make minus how much you spent to make that? And in general, if this is a side gig for you, if you are unmarried or if your spouse is not making a ton of money, if your other business income is not a ton of money, your quarterly estimates are probably going to be somewhere in the neighborhood of 25% of what you're making, your net income though. So if you make $10,000 and you spend $8,000 to make the $10,000 because you bought a new computer and this and that or whatever, office furniture, and so you have $2,000 left, you're going to send 500 of that to the IRS. That's the quick and dirty, easy method. And the reason I say 25%, even though the lowest tax bracket is 10%, is because when you're self-employed, you have to do your own payroll taxes. So we call them self-employment taxes. They're the exact same thing as the payroll taxes that come out of your check when you are employed. Only you pay both the employer side and the employee side. And that comes out to about 15%. There's a more complex calculation, but 15% is a nice round number we can all enjoy. And as long as you're making more than $400, you're going to have to pay 15% on that. And now I've just gone into all sorts of numbers, so my apologies. I know that not everybody is super comfortable with numbers, but the long and the short of that particular piece on making quarterly estimated tax payments is that if you're turning a profit, you'll want to make some estimated tax payments. Again, that's a great reason or a great time to find a CPA or to ask a CPA friend, or shoot me an email and I can help you with that. Okay, so we have a question about non-royalty income, like say that you're doing a speaking appearance, you get an honorarium. Can you deduct costs related to writing a future book? Throwing all income and expenses into the same pot? Yes, if it's cash this year. So let's pretend that you started writing a book and you're getting a speaking fee over here for $1,000, and you have all these expenses of writing the book, and you haven't sold the book yet, you're going to sell the book next year or whatever. Yeah, you can take the expenses on writing the book against the $1,000 you got for the speaking fee for being an author, 100%. Anything related to your writing, you can throw together into the same pot. That's fine. Advertising on a website, magazine, Facebook, absolutely 100%. That is deductible. If you've spent more than you've earned from writing, do the deductions help with income from your day job, or are they separate? So yes, they do help with, they can be counted against the income from your day job. The point or the question here is, That's why we have this show some income in 3 out of every 5 years. Those other 2 years, let's pretend that, oh, you thought you were going to sell the book this year. It was delayed. It didn't go on the market till January. So you only have residuals from the book you published 2 years ago. You got maybe $500 and you bought a new computer because you thought you were going to have all this income, and now you got a loss of, $1,500. Yeah, if you showed income last year and you're planning to show income next year, you can get $1,500 loss very reasonably. And that's fine. That's okay. And yeah, it is subtracted directly from all your other income. Should I have a home office? What's the advantage? Why? It seems really hard. Home offices are not that hard. A home office needs to be a separable and measurable space according to the IRS. It also needs to be a space where you could reasonably meet with a client. So it can't be the corner of the bathroom. It can't be the corner of the bedroom. It can't be the corner of the very musty basement. It can be the corner of your nice basement where you would have somebody down. It has to be 100% business use, and it has to be measurable and separable. So it's super convenient to use a room if you are lucky enough to have a home that has an extra bedroom or an office in it. Great, use it 100% business. Keep the exercise equipment out of there. Keep the guest bed out of there. Make sure that it is just a business space. Then that is going to be your home office. If you don't have an extra room to use, but maybe your basement is decent, you'd let people down there. It's not too many spiders. And you can make a corner, say out of a desk and a bookcase, and make a space that you could use and keep as 100% business use. That too can be your office. It may not have walls, but it is a measurable space. And it is a separable space. It can be separated out from the rest of the room because you have delineated it with a desk. You have the corner, and then you have a desk, and then you have a bookcase, making a nice little square or rectangle or whatever kind of quadrilateral you want. So, and that creates a home office. If you have a home office, you do get a nice little benefit, a nice little deduction of either $5 per square foot, and that's the super easy, quick and dirty, or the percentage that piece is as compared to the rest of your house. You can take off some mortgage interest, real estate taxes, homeowners insurance, utilities. So for some people, the $5 is going to be quick and easy, and that's going to be good enough. And for other people, if your home office space is exceptionally large, you can also include your storage space for your books. So if you have boxes of books that you have stored in a specific closet, that closet can be considered home office if it's only got work-related materials in it. And so you could potentially have 2 spaces that are your home office, one where you're writing and one which is your storage space. Again, 100% business use. And you could presumably open that closet and show anybody. If your favorite reader shows up on your doorstep and says, I want to buy all of your back catalog, you could open up that closet and say, here, pick one of, pick one of all, take one of all. The really, really cool thing about having a home office, though, is that it then allows you to deduct mileage. So with a home office, your commute now is down the stairs or across the living room or wherever, but it's inside the house. So now every time you get into that car to drive for business purposes, you get to deduct mileage. Mileage was up to, I can't remember what it is now for this year. It might be back up to 58.5 cents a mile or something. It's definitely well over 50 cents a mile though. And it adds up really quickly. And it is a super easy way to get some nice deduction and get some credit for that gas that you're putting in every time you drive, maybe to visit your editor or to take your favorite narrator out to lunch, or to go purchase supplies. Oh, good. Okay. 2021 was 56 cents a mile. Do we know 2022? And just anytime you're going to go to the office supply store, wherever you're going, then you have the ability to write off your mileage. In order to write off mileage, you need to keep a log. You keep a log by stating the date, the business purpose, and the number of miles. And so I could leave from here. Let's say I'm going to drive to the town 15 miles south of here because there is an author that I know, and we're going to talk about whether or not I'm going to narrate her books. So I leave my house, I have my little home office, I leave my house, I drive down 15 miles, we meet, I drive back, I have 30 miles to write off, plus I bought the coffee. And that kind of, oh, let me check questions. Show income or profit every 3 to 5 years, at least do a 0, if not income or profit. If you rent, can you deduct the square footage rent from the separate office space? Yes. So if you rent, you get to do the same deal as you do as a homeowner. So yes. And the discussion about mileage leads us into tracking things. So how do you track stuff? How do you keep track of all of your stuff? There's so much. And there's receipts, and you just want to shove them in a shoebox and forget about them. And that is one option. You can absolutely shove it in a shoebox. You can't forget about it, but you can hand them to your CPA. But you will make your CPA even happier if you have a little bit of organization behind it. So there's some mileage trackers. There's an app that several of my clients like. Is called, I think, Mile IQ, and there are other ones, and you just put it in your phone. Other ways of tracking it, I used to keep, I still do, who used to? I have a little notebook in the car, and I just write my miles on that. So I also have done it at work. I do have an Excel spreadsheet that I'm nominally supposed to be using. But I'm better with just writing it down as it happens, and I forget to fill in the spreadsheet. So do what works best for you. QuickBooks. I am now only a moderate fan of QuickBooks. For years, they had a really nice desktop QuickBooks program. It is still available. It will serve you well for many years, especially if you don't have payroll. It's a little bit pricey on the front end, but it lasts for a while. It is something, however, that you do need to make sure you watch enough videos on or otherwise get some training on, because it's easy to screw it up. But it is a good deal. If you are rocking and rolling in your business and you have quite a few expenses and quite a bit of income and really a lot of transactions, QuickBooks is an excellent way of doing this. It can get expensive, and they are moving to a subscription-based QuickBooks Online subscription-only service. I'm less enthusiastic about that, but I did for years. I did like their desktop, but again, this is when writing is your mostly your main deal, and you have a lot going on, and you have a lot of different things that you are needing to track and record. There's another program called Xero that I believe Xero. That seems to be very popular, especially in the UK, Europe, and it is slowly making inroads in the US. And my understanding is that it's a pretty nice program as well. But there are easier ways to do it as well. There's always paper and pencil. I grew up doing ledger sheets for my dad's business. So, and they still sell that lovely green ledger paper, and it's really nicely lined up so you can just write things down on it, add it up at the end of the year or the end of each month. I also created, and I'll screen share here. So I created, for an author friend of mine, I created this spreadsheet, and I've shared it with other people. It's gotten mixed reviews. So I will take any and all feedback on this if people want to try it. I believe it will be sent to you as a follow-up to this program. So what I did is I just took each month, and if it's green, you can write in it. So let's pretend you go and you see your CPA and they charge you $100 for the meeting. So you're just going to write that in there. And now you know in January you have this. And then let's say, oh, you spent $20 on office supplies. And then, oh, you signed up for the GCLS conference. So you got that. And that gives you a little, and it carries through, and each month has a different tab for it across the bottom. And if you only write in the green, at the end of the year, you have this cute little thing that shows you your income and then your total expenses. Oops, I forgot to add any income for myself. Let's say I got a $456 royalty check because it was a good month. So there. Then you have, and I have a couple of other tabs if you want to keep track of, you know, I bought a desk chair. And I bought it on February 5th of 22. And it's the black one because I also have a blue one. That will also help at the end of the year when you're figuring out, oh, what's the amount? I forgot the amount. I spent $250. It's a really nice chair. That will also help at the end of the year because you can write off your office, your new office equipment. So that's kind of quickly how this works. A spreadsheet is a really good idea. It's one of my favorite ways to track things. It also, though, can be scary for a lot of people, and that's okay. If you are not a numbers person, if spreadsheets look scary to you, seriously use paper and pencil. There's absolutely nothing wrong with that. And there's hopefully no CPA in the world who's going to judge you for that or otherwise give you problems around that. I think I see a couple questions. So question about basically setting up a home office for their employment work when they use the office just for day job and writing. Technically speaking, that is 100% business. There's no deduction on a tax return anymore for unreimbursed employee expenses. That was something that went away with the tax code of 2018. Remember when they rewrote the whole thing. So you don't get to take any kind of expenses for your day job if you are an employee. Taking classes toward an editing certification, absolutely. Any kind of education that you do. If you had paid to attend this course, you could write this off as well, because this is teaching you how to better manage your business and hopefully how to better calculate your taxes, right? The IRS loves that. If you purchase a new computer, can you deduct the entire amount in 1 year, or do you need to spread it out over a few years? If the new computer is less than $2,500, you can write it off in that 1 year. There's a special little election that you have to make. It's called a de minimis election, and now I'm speaking accounting again. But yes, you can. If, however, let's pretend you bought the computer and you published your first book in December. So with your $50 of royalties that you got for the sales that all happened on December 31st, but you bought your computer in November for $1,500. And you're kind of like, I probably actually, rather than take a big loss this year, I want more of that expense next year because I think I'm going to actually get some good money off of this book, and I'll probably get another book out, maybe even 2 more books out. So I'll have a lot more income next year. You would probably want to choose to depreciate that computer over several years. Typical for a computer would be 5 years. Depreciation, again, accounting term, something you might want to look up or talk to your CPA friend. Or at that point, if you think that you're going to be getting into that sort of a thing, look around and see if you can hire a tax accountant, a CPA. Let's see. And yes, classes toward an editing certification are deductible. You're proofreading for a publisher and they give you books in exchange instead of payment. Are the books considered income? Technically speaking, yes, you are getting paid for your services. However, there's also some question that you are all the books in payment for your services? Is it just that you have access to the catalog, right? So there are some benefits and there are some pieces in there that's super squishy, super gray. I would talk to, if you have a CPA that prepares your taxes, I would talk to them about how much of that and how to value that. But technically speaking, that's called barter. And for barter, you are supposed to report the fair market value of the bartering received. Does everybody do that? No, because not everybody knows that rule. So I think it's something that slips through the cracks a lot. Any questions, any further questions on that kind of a thing? Type of entity. So I had a request to discuss types of entity. And I can give you a little bit on this. So an LLC, that's the one that people talk about all the time. Should I be an LLC? I don't know. What about this? LLC is a legal designation. So it's not even a tax designation. I cannot talk about, because I'm not a lawyer, I cannot talk about the legal protections that an LLC might provide. I can tell you that if you just become an LLC, it's not going to change your taxes at all. However, if you become an LLC and you desire to change your taxes, you can make an election to turn that LLC and have it be taxed as an S corporation. And the advantages to tax of an S corporation come when you start making a decent amount of money. And when I say decent amount of money, I'm talking $60,000, $70,000, $80,000 or more per year. And I'm talking a net of 60, 70, 80 or more per year. If you get to that point, that is a really good time to go talk to a CPA and talk about making what's called an S election and becoming an S corporation. And if you are an LLC, you can easily make that S election. You don't have to have been an LLC before. You don't have to be one for X number of years. You can do the LLC and the S corporation election all in the same day, practically. So that's my 2 cents on entity selection. For the most part, the reason to do an LLC is for legal and legal protection purposes. And that comes about, or that decision should be made with a lawyer, not with a CPA. We are technically, as CPAs, not supposed to give advice on whether or not to be an LLC. From the tax perspective, the reason to do it would be because you want to become an S corporation because your business is doing really well. Yes, Maria, free tax prep services. So Maria, if you want to throw that into the chat, that would be awesome. So there are free tax prep services available through the IRS VITA program. And really, they do a wonderful job. So you get a lot of retired accountants, CPAs, and get some really great stuff. Let's see. Short stories. Do I need to include those as income if no single publisher pays more than $600? Yes, you do. So here's where we come into some confusion at times. Because 1099s are, you're only required, someone is only required to give you a 1099 if they gave you $600 or more, but you are required to report 100% of the income you receive for your services. So even if you sell XD number of stories and each only pays maybe between $10 and $50, and at the end of the year, Let's pretend it was a bad year and you're just, oof, $450 and that was it. Yes, you still have to report it all and you can take the expenses against it. Retirement. So if you work for somebody else, they're going to often have some kind of retirement program, retirement fund. 401k is the common one. You might hear about a simple things like that. What is available if this is your job, if this is your only job and you were like, oh, how do I save for my retirement aside from putting money into a bank account or into a taxable investment account? Where's my tax deferred deal? So there are a couple of different ways to do this. One of them that's a little bit fancier is called a SEP, S-E-P, self-employed plan. The SEP allows you to put in 20% of your net income into, essentially, we're talking again about a Schedule C, and I know I'm now using accounting terms again, but the SEP will allow you to put a certain amount of money away, tax deferred, so paying no tax right now, deducting it now, paying the taxes later, when you're retired, into a SEP account. And that's one really nice deal that you can have. It works best if you're making quite a bit more money. Because up until the SEP, or if your spouse makes a lot of money. So if your spouse makes a lot of money, you may not qualify for a traditional IRA or a Roth IRA. And in those cases, the SEP would be your choice. Or if your other job, if you have a job other than writing and you still want to put more money away, again, the SEP might be your choice. If, however, you're single, you don't have a high income spouse, you don't have a high income day job, whatever, using your traditional or Roth IRA is a great idea. They're super easy to deal with. They're super easy to use. It doesn't take much. In many cases, you can start one right online. You can manage it right online. You can also, if you're very risk averse, you can go down to the bank and get an IRA and fill it with CDs. If you like to play the stock market, you can go online and get an IRA and fill it with all the fun growth stocks. So, or somewhere in between. Right now, I'm big on the Roth IRAs. We've had a pretty low taxes for several years here and currently. And taking the tax deduction now might feel like a good thing, but if you're in the 12% bracket, you're only saving 12% on that. And if you stick it in a Roth and the Roth grows, and maybe you have other retirement funds, and maybe your spouse has retirement funds, or maybe you get married down the line, whatever, however, and let's pretend, or they increase the tax rates. And by the time you are retired, you have all this retirement money coming in, you've got your Social Security maybe, or you've married and your spouse has plenty of money coming in, and now your tax bracket is up at 25%. Well, why did you save taxes at 12% back here if you're going to pay 25% up here? So if you're in a low tax bracket now, and I would often say that would be anything 24% or lower, I recommend the Roth IRA. So you're paying tax on it now. So you're putting money into your Roth. You don't get a tax deduction, but it grows tax-free and it comes out later tax-free. And there are a lot of other good things you can do with a Roth. If you have kids, you can take money out of your Roth down the road to help with their college expenses. If you have not, if you're what's considered a first-time home buyer, and you've had, again, with all of these, you have to have had a Roth for 5 years. If you're considered a first-time home buyer, you can take up to $10,000 out of your Roth in order to, without penalty or anything, and regardless of age, to help pay for, to help make a down payment on a first home. So there are a lot of really creative, good things you can do with a Roth once you've had one for 5 years. The other thing too, that this isn't technically a retirement account, but it's a really slick deal. And this goes back to the health insurance question as well. So there was some question about self-employed health insurance. If you have a high deductible health plan, so health insurance that's going to have a high deductible on it, and it qualifies for a health savings account, not a health reimbursement account, a bunch of different other possibilities. You want the thing that works for a health savings account. You can put money into your health savings account every year. It's deductible, so you're saving taxes on it. It rolls forward, so it's not a use it or lose it situation. Once you have a certain amount in the account, you can invest it. It can sit in there forever. And once you're 65, you can take it out without penalty. Before you're 65, you can take it out without penalty for any medical expenses. So it's a really nice way to save taxes, and it actually is sort of a weird backdoor retirement fund. So that's another possibility for retirement. I see a question in the Q&A. So I have another question about 3 out of 5 years and showing losses. Says, if I'm racking up expenses, but I don't have any income until the 3rd year, can I deduct any of those early expenses? And I'm going to say, shoot me an email with your specific situation, because some of that's going to really depend. All right, now I think the piece that everybody's been waiting for. What happens when someone else's royalties, say my narrators, get reported on my 1099? And this is referring, of course, to the whole Audible ACX kerfluffle. And I can't comment, of course, I'm not a lawyer. I'm not going to can't comment on the legality of it or the this or the that about it. Yes, Karen, I totally agree in that chat. But here's what you can do about it. And there are a couple of different ways to handle this. And if you have a CPA and they say something different from me, it's probably okay. Different CPAs, there's a whole thing about you hand the same return to 400 different CPAs and you get 400 different returns. Tax code is gray. The best ways to handle this are one of 2 ways to do it. The first way would be to issue a Form 1099 to your narrator. So if the book garnered $1,000 worth of royalties in 2021, and 500 went to the narrator and 500 went to the author, and the author has received a $1,000 1099. Then the author says, okay, narrator, here is your 1099 from me for $500. In order to issue a 1099, you need special forms. You cannot do it on, there are ways to do it electronically online, but most of small 1099A filers will still want to use the red forms that the IRS requires. You fill that out, you get their name, their address, their social security number, you fill it all out. And now in your income on your Schedule C, yes, you are reporting $1,000, but down below on the Schedule C under expenses, you'll see contractors, and you're going to take $500 of expense there. So your net is going to be the $500 that Audible actually paid you. And you're transferring the $500 that they gave you, that they actually gave your narrator and reported to you. You're transferring that $500 out of your return as an expense. And then your narrator gets the 1099-R and they pick it up, or excuse me, the 1099 NEC, and they pick it up and it's on their return. There's another easier way to do this. Again, you're going to have to share social security numbers or whatever tax ID that 1099-R arrived in, and whatever tax ID your narrator uses. And it's called nominee income. And I think technically speaking, that's really what's happening here, is you are receiving, as a nominee, you are receiving income reported for your narrator. And no, it's not fair. But we just have to deal with it. So in this case, again, it's $1,000. The $1,000 does go in your income. So at the top of your Schedule C, it's $1,000. Then down below, under the other expenses, you would type in nominee income, and then you would type in your narrator's social security number. So if your narrator is Jill Smith, then you would type in and Jill Smith's social is 999999999. Then you would type in nominee 999999999 $500. And that's an expense deduction to you. So what you're telling the IRS is I received income that wasn't mine. I received it for this person, this social security number. And then the IRS can take that and they can match it up, because Jill Smith is going to say, I received income from Jane Doe Jane Doe received the report of my income and deducted it, and her social is 8888888. So on my income, then that's how that's going to work. Yes, Karen makes a great point. I see that just came through in the chat that said, yeah, you need to match their real name and their social. So if someone is using a pseudonym, you actually need to do it under the real name and the social that goes with the name. The IRS does not do well with pseudonyms. They don't even do well with birth names if you've changed your name. So that is the story. Well, I'd like to thank everybody for being here. Thank you, Karen, for sponsoring this. That's awesome. So pleased. And for those of you who enjoyed this presentation or found it helpful, please consider making a gift to GCLS. Certainly, the organization does a lot for all of us, and it's good for us to support it. So thank you. And any final questions in the Q&A, or shoot me an email, aeder@goodneyandassociates.cpa.
Thank you so much, Ann. What a great presentation. So helpful, insightful, really appreciated. And thank you everyone for attending this. We really appreciate it. It is being recorded, and I will be editing it at probably 3 a.m. tomorrow morning and uploading it to the GCLS YouTube channel. So be on the lookout for it. Thank you so much. We really appreciate it. Take care, everyone.